After 25 years as a mortgage broker, I can confidently say this. The biggest mistake homeowners make in 2025 is a cash out refinance when they should be looking into a HELOC. Do you have a great mortgage rate but need to tap into your home's equity? Imagine keeping your great 3% mortgage while still accessing your home's value. Your blended interest rate could be up to 3 to 4% lower than a cash out refinance. In this video, I'll show you exactly how HELOCs work and if they're the right move for you in today's market. Look, we're living in a high rate environment. Gone are the days when refinancing your mortgage was an easy way to access equity. Traditional cash out refinances simply don't make sense for most homeowners in 2025. I've got good news. That's where HELOCs come in. Think of them as a credit card secured by your home, but with much lower interest rates because your home serves as the collateral. They allow you to tap into your home's value while keeping your low rate mortgage intact. In this video, we'll cover everything you need to know about HELOCs, how to calculate your blended rate, qualify, and sharp smart. Stick around, this could save you thousands. And if you find this video helpful, hit that like button and subscribe to help grow this channel. A HELOC, or home equity line of credit, doesn't replace your current loan. Instead, it's a flexible line you can draw from whenever needed, typically accessed through online banking or a dedicated checkbook. HELOCs often have variable rates, but some lenders offer fixed rate options for more stability. You only borrow what you need, making it a great option for home improvements, emergencies, or even as a financial safety net. For example, let's say you have a $700,000 home with a 3% $430,000 mortgage, and you need $200,000 for renovations. A cash out refinance would replace your mortgage with a higher rate loan, likely around 7% or greater. But with a HELOC, you keep your current rate and borrow the extra at today's HELOC rate. Your blended rate could end up being much lower than refinancing everything. But before we dive into calculating your savings, let's talk about what affects your HELOC rate. Your blended rate is the average rate you're paying on your mortgage and HELOC combined. Here's how to calculate it. Take your balance of your current loan and multiply it by its interest rate. Then do the same for the HELOC amount. Add those numbers together and divide by the total loan amount. That gives you your blended rate. In my example, your blended rate would be 4.905%. Even if the HELOC rate sounds high, your overall blended rate will often be much lower than refinancing everything. Now let's break down how that HELOC rate is calculated. A HELOC rate consists of two parts, the index and the margin. The index is the variable part of the HELOC, usually tied to prime. As of this recording, the prime rate is 7.5%. Then there's the margin, which is the fixed part. For example, let's say the margin is 1.5%. Adding these together gives you a total rate of 9%. If the prime rate decreases to 7%, your HELOC rate would drop to 8.5%. On the other hand, if the prime rate increases to 8%, your rate would rise to 9.5%. The margin remains fixed, but it's how lenders price your rate based on your credit score and combined loan to value, also known as CLTV. A higher credit score and lower CLTV means a lower margin, which helps reduce your rate. But if you have a lower credit score and higher CLTV, your margin will likely be higher. Now that we know how rates are calculated, let's move on to how you can qualify for a HELOC. Now, to qualify for a HELOC, lenders look at three main factors: your combined loan to value ratio, your credit score, and your income. CLTV is your current mortgage balance plus the HELOC amount divided by your home's value. Most lenders want this ratio to stay under 90%, although the lower the CLTV, the better the margin. A higher credit score can mean a better margin. And lenders also want to make sure you can comfortably afford the payments based on your income. Once you're approved, though, it's important to understand the features of the HELOC you're choosing. HELOCs typically have two phases: the draw period and the repayment period. The draw period, which is often 5 to 10 years, allows you to borrow and repay as needed, often with interest-only payments during this time. And here's a key feature: if you pay down your HELOC and need to borrow from it again, you can, just like a credit card. Once the draw period ends, you enter the repayment period. This typically lasts 20 to 30 years and requires you to pay both principal and interest. No more draws are allowed at this stage, so it's important to plan your borrowing accordingly. Keep in mind that the rate is still variable once the HELOC becomes fully amortized. These features make HELOCs flexible, but also mean you need to understand the terms to avoid surprises. Now, let's go over how to shop for the best deal. Let's start by researching local and national lenders. Mortgage brokers can access multiple lenders and find a variety of HELOC options tailored to your needs. In contrast, banks and credit unions typically offer just one option, which may not always be the best fit. One of my clients recently saved over $1,000 by comparing offers and negotiating better terms. Shopping around can make a big difference. To sum it up, HELOCs let you access your home's equity without giving up your low mortgage rate. By calculating your blended rate, understanding qualifications, and shopping smart, you can save big. If you're ready to explore HELOC options and you're in Oregon, Washington, or Idaho, reach out to me below. And don't forget to like and subscribe for more real estate finance tips. Don't refinance and lose your low mortgage rate. A HELOC could be the smarter move.